non-discounted cash flows, non-discounted cash flows, and discounted cash flows. Okay, in traditional cash flows, there are two techniques. One is payback period method, and second one is accounting rate of return method. Okay, payback period method formula is original investment divided by annual cash outflows after tax. For the accounting rate of return, average annual EAT divided by original investment. This is for traditional techniques. Second one is non-traditional or modernization or discounted rate of cash flows techniques. Okay, that is first one is NPV, net present value. Second one is IRR, internal rate of return. Third one is profitability index. Okay, for this technique, we use the two things: initial cash outflow after taking the discounted cash, after taking the discounted initial present value of cash inflows minus present value of cash outflows. Okay, when this project is, we are taking 2 or 3 alternative projects. In that, which one is giving more returns based on this NPV values. Okay, when we accept the project means we accept the project NPV is more than the zero. When, for example, for example, cash inflows are 3 lakhs. Sorry. Cash inflows are 3 lakhs. Okay, and outflows are, present value of outflows are 2 lakhs. Okay, for how we will calculate the NPV means present value of cash inflows minus present value of cash outflows. How much cash inflows? That is 3 lakhs is a cash inflow, and initially we are paying the amount, that is cash outflow is 2 lakhs. Difference between inflow and outflow we call as NPV. Okay, how much it is? 1 lakh is a NPV. This is more than the zero. Okay, this is more than the zero. Then the project we will accept. Okay, if this inflow values only 1,50,000, then we are paying the money 2 lakhs, but in return we get only 1,50,000. So on that time we rejected the project. Okay, NPV is less than the zero. Okay, in that time we are not taking the project. Okay, these are all the advantages of inflows, net present values. Okay, in this net present value, in NPV technique, they are considered the time value of money, and it uses all cash inflows and including scrap value of old project. Okay, in previous project, how much? So 1 minute. Okay, for okay, this is the advantages of NPV technique. That is, it is considered the time value of money, and it is taking the scrap value of old project amount, and it is particularly useful for the selecting mutually exclusive project. Mutually exclusive project means here 3 or 4 alternative projects are there. In that for example, A, B, C, D. Likewise, there are 4 projects are there. In that particularly, which project giving more returns to our organization, then we will take that project. Okay. For example, A gives the 4 lakhs returns, and B gives the 3 lakhs returns, and C gives the 1 lakh return, and D gives the 5 lakhs return. So obviously, which project it is giving the more return? So that project we are selecting, okay, through NPV technique. Project D giving after taking the present value of discounting factor, D giving the 5 lakhs rupees. So compared to about three projects, project D is giving fourth project D is giving more returns to the project. So likewise, in mutually exclusive projects, we are comparing the each other projects, and it is considered with the objective of maximization of shareholders' wealth. The main motive of any technique, they are creating more worth or more returns to the equity shareholders. This is the regarding to the net present value, and IRR, internal rate of return. Okay, internal rate of return, it is the discount rate at which present value of cash inflows equals to the present value of cash outflows. Okay, at what rate of discount present value of cash inflows and present value of cash outflows are equal. So that technique we call as IRR technique. It means this is the formula for IRR technique, that is present value of cash inflows equal to present value of cash outflows. It is also known as trial and error method. Okay, yield on investment rate of return, time adjusted rate of return, and also and so on. And here we are taking the trial error method. Okay, where which discounted rate of cash inflows and cash outflows are equal. Of IRR is based on the cash flows after taxes. We are taking the cash flows after the taxes. How much tax we are paying, how much return we are getting through financial statements. In the financial statement, we get the net profit. Okay, net profit. How much net profit we are getting? For example, we have XYZ Limited, and this financial year, after completing this March, a particular X and Y Limited getting the 10 lakhs rupees of net profit. So that is we call as in financial statement we call as net profit, and in our terminology regarding, that is also called as earning before interest and tax. It means after before paying the interest to the debenture holders or bank or other preferential shareholders. Okay, and also we are not paying the tax to the government. Okay, this is called as EBIT. EBIT means earning before interest and tax. This earning before interest and tax. Okay, here EBIT is our net profit is net profit or EBIT. This amount is 10 lakhs rupees, and we are paying the interest to the particular debenture holders. This is 3 lakhs. That is 7 lakhs is a earning before tax EBT. Okay, and the tax rate is 10 percentage. Okay, 10 percentage means 70,000. Okay, 70,000. They are deducting the 70,000 on 7 lakhs. 6 lakhs 30,000 is EAT, earning after tax. This amount we are paying to the equity shareholders. Okay, this is we called as earnings after tax. So computation of IRR is based on the cash flows after tax. We are taking the amount of this amount, not the net profit or EBIT. We are paying the interest, and after paying the tax, we are taking this EAT to the calculation of IRR. Okay, IRR is the mathematical representation of R. Okay, we are representing IRR equal to as R. Okay, IRR equal to LDF in percentage plus delta DF present value of uh, okay okay, this is the formula for the This is the formula for the IRR method. And decision role is cost of capital. We have discussed earlier topics. Cost of capital, that is preferential shares, debentures, and equity shareholders. We are paying the each. We are paying the interest to the debenture holders, and preference dividend to the preferential shareholders, and we are paying the dividend ultimate owners of equity shareholders. So that cost of capital uh, is more than the IRR. Okay, when the IRR is more than the cost of capital, then we will accept the project, and IRR is less than the cost of capital, we are rejecting that particular project. Okay, we are taking the cost of capital for comparison purpose. Okay, and in NPV method, we are taking the cash inflows and cash outflows. Okay, but here we are taking the IRR with we are calculating the IRR and compared with the cost of capital. Which, if cost of capital IRR is more than the cost of capital, then we will accept the project. If IRR is less than the cost of capital, we are rejecting the project. Okay, and it's take the account time value of money. Same likewise, NPV, and net present value. Likewise, we are considering the time value of money, and it is self provides a rate of return which is indicative of profitability. Okay, here we are calculating the return. So this return getting the how much profitability, it is indicative of profitability. Okay, so this is the regarding to the each technique. Okay, in capital budgeting, we have 5 techniques. We are dividing the capital budgeting techniques in 2 categories. First category is traditional method, and second category is non-traditional. That is discounted method. Okay, in traditional method, one is payback period method. Second one is ARR technique, accounting rate of return technique, and for discounting or non-traditional techniques are 3. One is NPV, IRR, and profitability index. Okay, this is regarding to the capital budgeting topic. Okay, we are going to the next unit, that is we are concluded up to this capital budgeting, and this is next topic, that is black 5, dividend decisions. Okay, in dividend decisions, second chapter, that is dividend policy. First, what is mean by dividend? Dividend is the term dividend is refers to that part of profits of a company which is distributed by the company among its shareholders. Dividend means it is a part of profits. Okay, we have equity shareholders, but lack of equity shareholders, actual owners of that particular company is equity shareholders. Okay, we are paying off, we are getting the profit, then particular organization getting the profit, then they will be paid a dividend to the equity shareholders. Okay, dividend means it is a part of profit. Okay, we are dividing the profit dividing the profit. Earlier we discussed EAT. Earlier we discussed EAT. How we get the EAT is EBAT means net profit. Okay, after deducting these things, and we get the EAT. This is the amount. This amount that particular company or particular organization paid to the equity shareholders. For example, that particular company have 630 equity shareholders. Then how much dividend they are receiving? It means For 6,30,000 is the earnings after tax, and 630 is the equity shareholders. There is a that particular company actual owners are 630. So how much they get means each one getting 1,000 rupees for dividend every this particular financial year. Okay, this is we call as dividend. Dividend means it is a part of profit. How much profit we are getting here? 6,30,000. So see, in 6,30,000, each one shareholder getting the 1,000 rupees. Okay, this 1,000 rupees we called as a dividend, and it is the reward of shareholders for investment made by them in the shares of a company. Okay, what we call dividend is called, actually it is reward to the particular shareholders. So they are taking the risk for they are taking the risk through they are investing the money in that particular company. So that risk they are taken to the shareholders. So we are giving the reward to the particular shareholders. The value of the firm can be maximized in the shareholders wealth maximized. So when the shareholders wealth is maximized means the value of the firm will be maximized, can be maximized automatically. Shareholders wealth also maximized. And dividend policy of a firm in distributed net earnings to the equity shareholders. Okay, earlier we discussed here now. So actual dividend, actual profit is distributed to the actual equity shareholders. Okay, this is regarding to the basic introduction to the dividend policy. And here we have three theories. One is Walter's approach, Gardner's approach, M&M approach. Okay, there are two theories. One is relevance theory, and second one is irrelevance theory. Okay, in relevance theory, we have two approaches. One is Walter's approach, and second one is Gardner's approach. And in irrelevance theory, we have MM approach. MM means Margolani and Miller approach. Okay, in Walter's approach, this concept is developed by Walters. That is, Professor Walters' approach is supported the doctrine that dividend decisions are relevant and affect the value of the firm. Okay, Walters is argued that dividend decisions are relevant. Okay, relevant means it is influencing the organization, it is influencing the customers. Okay, it is influencing the outsiders. Okay, when the dividend decisions are relevant to the particular company. Okay, so after with this, it is effective value of the firm. And Professor Walter's model is based on the relationship between the firms. Okay, here we have two things. One is return on investment. Second one is cost of capital. Means cost of capital means required rate of return. Then R is a actual return on investment. How much we are investing and how much we get through on investment. First thing. Second one is actual expected return or actual cost of capital or required rate of return is a we are show like a K. Okay. Here we have three concepts. One is growth firm. In which stage is there? Which stage are farm is there? One is growth farm or declining stage farm. Third one is normal farm. When we will call as a growth farm, or when we will call declining farm, when we will call normal farm means the growth farm when return on investment is more than the expected or required rate of return, then particular farm is on a growth in nature. Okay, and the optimum payout would be zero. And that particular time, the in growth approach, optimum payout rate would be a zero. In this case, we would get the maximum value of the firm share value. Okay, in this growth stage, each shareholders are firm getting the maximum returns. Okay, this stage we called as growth stage. Second one is declining stage. When we will call as a declining stage is nothing but declining firm which do not have profitable investments. That is where R less than the K, the shareholders would stand to gain if the firm distributes its earnings. For such firms, the optimum payout would be 100%, and the firm should distribute the entire earnings as dividend. In this stage, this declining stage, firm paying the 100% uh, dividend earnings to the equity shareholders. Okay, in this stage, not retaining the any money. Okay, but growth stage, they are not paying the optimum payout would be zero on that particular time. In growth stage, optimum payout rate is zero, but here declining stage, payout would be 100%. Okay, third stage is dividends, and here now in normal stage, return on investment and cost of capital are equal. In this stage, in the case of normal firm, where R equal to K, R is a return on investment. Okay, R is a return on investment. K is a cost of capital. Okay, in both are here both are same in particular normal form. The dividend policy will not affect the market value of the shares as the shareholders as expected by them. For such firms, there is no optimum dividend payout, and the value of the firms would be not changed with the change in a dividend rate. Okay, here the value of the firm is not changed until the change in a dividend rate. Okay, this is stage, the entire things are in normal nature or stable nature. Okay, this is the assumptions regarding to the Walters model. The investment of the firm, the financed through the retained earnings only, and the firm does not use external source of funds. Okay, here in first assumption is that particular firm not taking the money from the outside. They are using money from internal source only, or they are using the retained earnings only. And the second assumption is the internal rate of return and cost of capital of the firm are constant. Okay, the cost of capital and internal rate of return (IRR) or return on investment are constant. There is no changes in that particular K and R. Earnings and the dividends do not change while determining the value. Okay, earnings and dividend does not change for determining the value. Okay, a particular value, that is EPS and EPS constant. The farm has a very long life, but that particular farm is have long life. Okay, conclusion is in that particular Walters model, when the our return on investment is more than the cost of capital, then the company should retain the project profits. Okay, profit, that particular company have more profit in this stage, return on investment more than the cost of capital, and the payout should be high. The payout we are paying high when r less than r equal to k. Okay, when the k is less than or equal to r, then we will call as a this second stage. And fourth one is second stage we call as a declining stage, and third one is r equal to k. This is a neutral stage or normal stage. That the dividend payout does not affect the price of the share. Okay, this stage dividend payout is does not affect the value of the firm. So this regarding to the Walters model. And second model is Gardens approach. This is the assumption regarding to the Gardens approach. Okay, these assumptions are the firm is an all equity firm. Okay, same likewise in Gardens model. First assumption is same, that is all we are getting the money from, we are not getting the, or we are not taking the money from the outsiders, we are taking the money from internal source only, or through return earnings, or we are using existing shareholders money. Okay, and the second assumption is no external financing is available for used. Okay, they are not using the external finance, and return earnings represents the only source of financing investment programs, and the rate of return on farm investment R is constant. Okay, here rate of return and the farm's investment R is same, and the retention ratio B once decided upon the constant, thus the growth rate of the firm G equal to BR is called as constant. Okay, in this stage, G equal to BR is called as a constant stage, and the cost of capital for the firm remains the constant, and it is greater than the growth rate. That is, uh, when the when the interest rate is more than the growth rate, then we will call as it's remaining. It is in that particular stage also it is constant. And the last thing is the firms has a present perpetual life. Corporate taxes do not exist. Okay, this is regarding to the guardian's approach assumptions. And when growth form R is more than the K, then we will call as growth form, and R is equal to K, then we will call as a normal form, and R is the less than or less than is equal to K, then it is this stage is we call as declining stage. Okay, this is regarding to the Gardner's approach and Walter's model. And third one is, okay, third thing is model. Third model is model. Means Margulani and Miller approach. Okay, this is we call as approach. It is a irrelevance theory. Okay, in before to are relevant. It is affects the value of the firm based on returns. Okay, but here the approach, it is irrelevance. It is irrelevance theory, and a dividend policy has no effect on market price of the share. Okay, this is the approach. That is, it is as called as it is a irrelevance theory. The dividend policy has no effect on the market price of the share, and the value of the firm is determined by the earning capacity of a firm or its investment policy. Okay, in this particular model, dividend policy has no effect on market price of the share and value of the firm. Okay, it is not affect, dividend is not affecting the market and also value of the firm. This is the first thing. And assumptions are there are perfect capital markets. Investors behave rationally. Okay, rationally means uh, when we are getting the more returns with the less risk on that stage. Okay, investor simply leave that before organization, then they will go to purchase other more return share value. Okay, and the third assumption is the information about the company is available to the all. Information regarding to the company, regarding to the all, it is available, and there are no flotation and transaction cost. Flotation means when the time we are issuing the shares, we are giving some discount to the debenture holders or preferential shareholders. So that discount we call as flotation cost and transaction cost are on that particular time for issuing time. They are organization they incurred some expenditure regarding to the advertisementing and for taking the investment from the outsiders. So on the time, so this is also not affect the value of the firm, and there are either no taxes or no difference in tax rates applicable to dividend and capital gains. Okay, there are either no taxes or no differences in the tax rates. This is regarding sixth assumption. Seventh one is the firm has a right investment policy. Okay, the particular company has right investment have before have some required investment policy, and there is no risk or uncertainty in regarding to the future of the firm. Okay, they are not taking the any stress or any risk regarding to the for continuous purpose. Okay, these are all the types of dividend policies. That is first one is regular dividend policy. Second one is stable dividend policy. In that particular regular dividend policy, payment of individual in payments of dividends at the useful rate, it is termed as regular dividend. Okay, ఒక్క నిమిషం. Okay, types of dividend policies. There are four types of dividend policies. One is regular dividend policy. Second one is stable dividend policy. Third one is irregular dividend policy. Fourth one is no dividend policy. In this regular dividend policy, payment of dividend usual rate of return, usual rate of rate, it is termed as regular dividend. So before we are issuing the shares to the debentures to debenture holders. So on that particular time, company advertising 10% at the 10 percentage rate of rate of interest. We are getting the money from you. So likewise, 10% percentage of money or dividend every year that particular company pay. And the second one is stable dividend policy. In this stable dividend policy, certain minimum amount of dividend regularly paid. In this particular stable dividend policy, a particular company or organization, every time they are paying fixed nature or certain minimum amount of dividend to the paid to the particular dividend holders or equity shareholders. In the constant dividend per share, first thing is in stable dividend policy, first one is constant. Every year they are paying fixed dividend. Every year they are paying fixed dividend per share. That is, every year they are paying 100 rupees to the 100 rupees to the each share. It means every year they are paying, first year paying 100 rupees, second year paying 100 rupees. Likewise, in the lifetime they are paying fixed amount of dividend to the that particular shareholders. And second one is constant payout ratio. Every year, first thing is they are paying in fixed dividend per share. It means every year they are paying 100 rupees, 100 rupees likewise. But constant payout ratio means every year they are paying 10 percentage or 15 percentage. Every year they are maintaining the same likewise dividend payout ratio. Okay, stable rupee dividend plus extra dividend. In this third stage, third thing is every year they are paying 100 rupees basically plus, and also in certain cases company getting more returns every year. So on that particular time they are paying what they are paying every year 100 rupees with adding some more amount to the particular before dividend value they are paying. That is called stable rupee dividend plus extra dividend. Third one is irregular dividend policy. Irregular dividend policy means some companies follows the irregular dividend policy, and all are not following the same rule. But some companies are following irregular, and they are paying one or two. For example, this financial year, X Limited is announced 10 percentage of dividend we are paying, but next year or coming years or before year they are not paying the any dividend. So they are not paying regularly. It means irregular payments of dividend. Okay, fourth one is no dividend policy. Some companies have, there is no dividend policy regarding to the this concept. A company may follow a policy of paying no dividend, but presently, because of it is unfavorable working capital position or on account of irrequired requirement of funds for future expansion or growth. So this dividend amount that particular company using for expansion of the project or growth growth related. This is called as the types of dividend policies and form of dividend. Okay, how they are paying are cash basis or kind basis. Okay, forms of dividend is first one is cash dividend, second one is script or bond dividend, third one is pro- mm, property dividend, fourth one is stock dividend. So in first thing, dividend is giving through medium of cash. It means in cash dividend is usual method of paying dividend. Okay, usual method of paying dividend means usually they are paying money to the in return to the particular shareholders. Scrip or bond dividend. Scrip dividend promises to pay the shareholders at a future specific date. Okay, and in case of a company does not have sufficient funds to pay dividend in cash, it may issue notes or bond for a amount due to the shareholders. Okay, some in some cases or some cases some companies are uh, not getting the effective rate of returns or not getting the sufficient profits. On that particular time they are giving some script to the okay, for paying the dividend, company paying the based on not in a cash but based on bonds or scripts. And the third one is property dividend. In that particular dividend form is a company giving some property to the particular equity shareholders. And the fourth one is stock dividend. Stock dividend means the issue of the bonus shares to the existing shareholders. Stock dividend amounts to capitalization of earnings and distribution of profits among the existing shareholders. So in this particular bonus shares, company issuing the bonus shares to the only existing equity shareholders without taking any money. Bonus shares means company not taking any money, but they are using the internal resources or internal reserves for uh, for this purpose of issuing bonus shares. Okay, up to this we concluded this chapter. See the page number 234. Bonus shares means okay. In this particular retained earnings concept, every year company not paying consumption. Okay. In earlier topics, we concluded that up to dividend policy. This is the fifth block. In this fifth block, we discussed up. We completed up to this dividend policy and determinants of dividends and retained earnings. Also, it is very small topic. Retained earnings are, you see the here book. This is the Walters model relevance theory concept. That is more we are getting the more returns compared to the cost of capital. Then the stage is called as growth stage. And the second thing, we are getting the returns less than the cost of capital. It is called as declining stage. But here payment ratio is 0. But here payment ratio is 100% in this particular stage. And retained earnings are R equal to K in this, then we will call as a normal stage regarding to the Walters model. And this is the formula for the Walters model. And this is one example regarding to the Walters model. Okay, see the problem. And in Gordon's model, we discussed it before. Okay, and certainty, evident relevance. Relevance theory is a approach. It is regarding to the relevance regarding to the approach. Okay, this is the assumptions, and these three concepts are very important. Every time they are asking, discuss about the relevance theory regarding to the dividend policy or irrelevance theories. Okay. Okay, dividend is depending upon the this below constraints, that is age of the company, how many years of for that particular company, before how many years they are how many years before they are establishing or control objective, who they are controlling, and nature of the stockholders are all are equity shareholders are sum of portion. So stakeholders nature and steady and stable demand. Okay, uh, how the demand position is how much. Okay, these are all regarding to the particular constraints of payment of dividends. Okay, this is the important topic. Difference between the bonus issue and stock split. Bonus means the par value of the share is unchanged. Okay, here value of the share, that means each unit, each particular share value is 100 rupees, but that particular 100 rupees is not changed for issuing of bonus shares. But in stock split, for example, recently IRCTC have 5,000 rupees of share, each one share value. Uh, on that particular time, IRCTC is divided by dividing the they are IRCTC giving to the each shareholders are each share subdivided into 5 parts. Then the share value is on that particular time 1,000 rupees. Okay, stock split means we are dividing the stock prices. Okay, we are dividing the stock prices. Here bonus shares is the part of reserves is capitalized in that for issuing of bonus shares, we have that particular company is using reserves to reserves. And stock split in this concept stock splits, no part of reserves is centralized, and shareholders proportional ownership remains unchanged. Okay, ownership partnership of the ownership of the particular shareholders not changed in that particular bonus shares, but shareholders proportionate ownership is remaining unchanged. Both are same in that particular bonus shares and stock splits. The book value of per share is earnings per share and market price per share is declining. Here book value, earning per share value, and market price is decline. But in particular stock splits case, the value book value of per share is earnings per share, and market price of the share is decline. The fifth one is, fifth difference is the market price per share is brought within a particular trading range. And here stock split, the market price per share is brought with more popular trading range. Okay, this is the main difference regarding to the stock split and stock bonus shares. Okay, I concluded here. Thank you.